Hello, and thank you all so much for joining us for today's presentation, The Benevolent Bitcoin, Considerations When Gifting Virtual Currency. My name is Rebecca Bibelheimer with the Oregon Community Foundation. I'm so honored to get to introduce our three amazing speakers today. All three are attorneys with the very well-known and well-respected firm Baker Botts, which is a leading global law firm. The three attorneys we have presenting for us today from that firm are Jon Feldhammer, Katie McEvilly, and Richard Ramirez. Thank you very much for agreeing to speak, and thank you to everybody who's joining us. A little bit of more information about them. Jon Feldhammer is a former IRS senior trial attorney. He works on complex tax controversies for clients before the IRS, California Franchise Tax Board, and other state agencies. He represents clients at every stage of a tax dispute, including examination, appeals, and litigation. He advises clients on tax compliance issues and assists corporations, partnerships, and individuals in navigating the challenging tax environments involving income, estate, gift, employment, and international tax issues. In addition, Kate McEvilly focuses on U.S. federal income tax matters. She advises clients on mergers and acquisitions, joint ventures, securities offerings, and transactions involving consolidated groups, master limited partnerships, and 5 corporations. She also advocates on behalf of large companies and high net worth individuals in tax controversy matters nationwide. And lastly, Richard Ramirez handles all aspects of estate planning and estate administration for high net worth individuals, representation of fiduciaries and beneficiaries in estate and trust administration, and representation of charities. He primarily focuses on preparation of wills and trusts, lifetime transfer of assets, and restructuring family-owned businesses. His practice emphasizes the implementation of advanced asset transfer strategies that preserve estates by minimizing federal gift and estate taxes, as well as strategies to transition ownership of family businesses and legacy properties from one generation to the next. Thank you so much to our speakers, and thank you to each of you for joining us today. And with that, I will hand it off to our speakers.
Thank you so much for that introduction. We're the Baker Botts team, and we're here today to present on the Benevolent Bitcoin, how to gift virtual currency. So just to start, we wanted to thank you so much for having us today. Thank you to the Northwest Plan Giving Roundtable, and we really look forward to giving you this presentation. Today we have 3 speakers, Richard Ramirez, Jon Feldhammer, and me, I'm Katie McEvilly. We'll do a deeper dive into our backgrounds and where we office following each of our 3 sections. Our presentation today is divided into 3 different sections. In part 1, we have just an overview of blockchain and virtual currency. That'll be given by Jon Feldhammer. He's going to go over the terminology, get you up to speed on what a centralized and distributed ledger is, and also go through a Bitcoin example for you. I'll handle part 2, that's the tax considerations and recent IRS developments with virtual currency. I'll talk about just what are the general tax principles for virtual currency transactions, what are some things you see when you're gifting and accepting gifts of virtual currency, and then showing you some recent IRS developments with respect to virtual currency. Richard Ramirez will handle part 3. That's on planned giving techniques and considerations, going to review all the things that are so great about virtual currency, going over some planned giving techniques, and then some issues that you might see when you're gifting virtual currency. So with that, I'll hand it over to Jon.
All right, thank you, Katie. I'm Jon Feldhammer. I'm a tax controversy attorney, and I've actually been disputing various cryptocurrency transactions with the IRS. Let's go to the next slide, Katie. So, virtual currency, what is it? Well, the IRS's definition is it's a digital representation of value that can be exchanged. And this concept has been around for years. It started out really in video games where you had at first multi-user dungeons, and that became World of Warcraft, and now you have Fortnite, and you have this currency that's transacted in these games. Well, that's now been extracted and built on, and now it's a real world currency. cryptocurrency is a type of virtual currency, and it uses cryptography to secure the transactions and to control the creation of new currency units. Cryptocurrencies typically use blockchain, and understanding the blockchain is the key to understanding cryptocurrency. Blockchain is a disruptive technology. It could upend many industries. What it is, it's a shared immutable ledger for recording the history of transactions. It can store virtually any data, but it's this large public shared ledger. So what else works like that? Well, security exchanges, NASDAQ, that enables direct value transfer and record keeping. Well, blockchain can do that and eliminate the need for costly intermediary, i.e. NASDAQ. Distributors, it could bring buyers and suppliers together directly and allow them to conduct their transactions via blockchain. For blockchain key technologies, it's critical to understand these technologies and the underpinnings of cryptocurrency so that you can learn how to plan around crypto, how the tax laws may apply to crypto, and understand the challenges inherent in cryptography, and especially the planning and transactional nature of it. So one of those key technologies is public key cryptography. The idea is you have two keys. You have a private key you keep secret, and you have a public key that you share. How it works, how public key cryptography really works, is you sign something, a transaction with your private key, and anyone can use your public key to verify you signed something with your private key. So even though your private key stays private, other people can verify that you signed it by using the public key. And it's pretty, it's called infeasible, but it's really quite difficult, almost impossible to figure out a private key from a public key. Another key technology for blockchain is hashing. Algorithms, what hashing is an algorithm that takes an input of any length and gives an output of a fixed length. So you could have a whole paragraph and it comes back out with a fixed length output. Well, Bitcoin uses what's called SHA-256, secure hash algorithm. That means it gives you an output of 256 bits. And bits are basically, you can think of it as characters. So you have A, B, C, D, E, F, G, for example. So you give it a paragraph, you get 256 bits out. You give it a sentence, you get 256 bits out. You give it one character, you get 256 bits out. So no matter what you put into it, you get 256 bits out. And the output for a given input is unique, but the output for the same input will always be the same. Now, distributed ledger technology, that's probably easiest to explain by example. So with a good example of a centralized ledger is Encyclopedia Americana. That has a single source of information. The publisher is the source. Whereas Wikipedia is an example of a distributed ledger because it has multiple contributors and it's distributed. With a centralized ledger, you have a ledger that's maintained by the central authority. So in this example on the left here, you have a clearinghouse. That clearinghouse, and it could be a bank, it could be NASDAQ, we're very used to centralized ledger systems. They can impose, and the central clearinghouse, that centralized ledger, imposes transaction fees, service charges, things like that. It's fast, but susceptible to error, outage, and attack. It has a single point of failure. Whereas a distributed ledger, well, everyone maintains a copy of ledger. There's no central authority. It's less expensive. Right now, it's slow, but it could be fast in the future. And it's less susceptible to error and outage and attack. And blockchain is a distributed ledger. So what is a Bitcoin? Well, Bitcoin is the world's largest virtual currency. So we're going to use it as an example for understanding cryptocurrency because other cryptocurrencies work similarly. I've underlined key defined terms here. So a Bitcoin is a reward from the Bitcoin blockchain you get for mining a new block. The Bitcoins are stored on the blockchain, and you have an address to those Bitcoins, which is the hash of your public key. And you can send those Bitcoins using your private key. So now you know what the essence of a Bitcoin is. It's the address of a mining reward. And that's why you hear so much about Bitcoin miners. There are people trying to algorithmically find new blocks in order to get more Bitcoins. But you need those blocks in order to log transactions so that you can know you add them to the ledger of who spent the currency. Now, how does it work? So as each transaction occurs, it is put onto a block, and each block is connected to the one before and after it. Transactions are blocked together using hashes, and each block is added to the next in an irreversible chain. And here's a diagram of a very basic, simplified way this works. And as you can see, each block has a hash of the previous block, and everything is linked together by hashes. You have every transaction, every block. Copies of each transaction are hashed, and then hashes are then paired, hashed, paired again, hashed again, until you have a single hash. Now, why is this important? Well, because if you change a single transaction in a single block, then you change every hash in every following transaction and every following block. Well, this means that the second someone tries to change something like, oh, well, you gave me 2 Bitcoin, not 1, everyone who has a copy of this blockchain, and everyone has a copy because it's a distributed ledger, sees their blockchain looks nothing like yours. It means you did something to your blockchain that is not authentic, and then it's rejected. And this is what makes the blockchain ledger immutable. So what is a Bitcoin wallet? Well, a Bitcoin wallet, all it is it's an address, which is just a hash version of your public key, and a private key. So this means that a Bitcoin wallet could be anything. It could be a mobile app, it could be desktop software, it could be a website, or even a piece of paper. And this, what I've shown here is an example of a paper Bitcoin wallet. You have the private key down here, and you have the public key. And the private key, if someone gets access to that, now can spend your Bitcoin that might be in this wallet. The Bitcoin wallet only needs the private key because the public key is derived from a private key. And the easiest way to think of a private key is a password, a very complicated password. If you lose the private key, you can no longer sign a transaction conveying the Bitcoin held by that wallet. It is then stuck. If someone else gets that private key, they can take the Bitcoin held by that wallet. They could sign a transaction conveying the Bitcoin to a new wallet, a new public key, a new address. So here's an example on the next slide. Of sending a payment. So if A wants to send 1 Bitcoin to B, well, the way it works is B sends his public address to A. A then adds B's public address and the amount of Bitcoins to transfer to the message, and this is a transaction message. A signs the transaction with her private key and announces her public key for signature verification. A broadcasts the transaction on the Bitcoin network. And then once the transaction is confirmed, that has been added into a new block. It's been confirmed so many times, and Coinbase, for example, requires 3 numbers of blocks that have been added, which is 3 confirmations. Then B can be confident the transaction is permanently recorded, preventing A from spending the Bitcoin again. Blocks are added about every 10 minutes, so your transaction might not show up for 10 minutes. There's complexities there, but that's the basic idea. Now, this is what a transaction actually looks like. And you can see you have things like you have these keys and hashes, and that's what these 256-bit numbers are. And then you have the number of Bitcoins and things like that. This is a somewhat visual representation of what an actual transaction looks like. So what is saved to the blockchain? Well, it's a sender's address, a receiver's address, the amount of Bitcoin transferred, timestamps. That's pretty much it. What's missing? Well, there's nothing personally identifying about the transaction. It's just telling you that someone sent some amount of Bitcoin from one public key to another. Anyone can create a public key pair and a hash of the public key. So I can just generate one at random. There's websites where you just generate those keys. So there's nothing unique or identifying about it. Katie, you want to take it over?
Yes, thank you, John. So my name is Katie McEvilly. I'm a senior associate with BakerBots in our income tax group. Like John, I do a lot of tax controversy work, but I also do tax planning, especially for corporate taxpayers. In both our tax planning and tax controversy, I advise on 501c3 organizations, and I help clients form 501c3 organizations. With respect to virtual currency in particular, that's just become an interest in mine, especially over the last few years. It's been really fun for me to follow IRS developments in this area and watch it become the hot button issue that it has today. For this part 2, we'll be doing a deep dive into some of the federal income tax considerations of virtual currency and exploring some recent developments by the IRS in this area. So if you want to get up to speed on everything that the IRS has published about virtual currency, you could do it pretty quickly, under an hour, over a cup of coffee. There just really isn't a lot of published guidance out there. The IRS first addressed virtual currency back in 2014, when virtual currency was still in its earliest forms. The IRS issued Notice 2014-21, and that set forth the IRS position that virtual currency is property for tax purposes, and not, for example, currency. So because virtual currency is property, you just apply all the existing tax principles that are applicable to property transactions generally. Then the IRS waited 5 years, totally silent, and then just last year in 2019, the IRS issued Frequently Asked Questions and Revenue Ruling 2019-24. The Frequently Asked Questions, that's just a natural extension of Notice 2014-21. It reiterates the IRS position that virtual currency is property for tax purposes. And then the Frequently Asked Questions gives just a whole bunch of examples of how you apply these general tax principles to virtual currency transactions. One interesting thing that comes out of the Frequently Asked Questions is how to value virtual currency. In Notice 2014-21, it said, will you value virtual currency on the date of a transaction, and then you convert that at an exchange rate applied in a reasonable manner that's consistently applied. In contrast, the Frequently Asked Questions say, no, you value virtual currency at the date and time that the transaction is recorded. So this is more of a bright line approach, and Richard in part 3 is going to flesh out some of the more details in what it means to value something at the date and time. The weeds on this, but suffice it to say that virtual currency does have unique features, and it's not really enough for the IRS just to say, well, you apply general tax principles that are applicable to property transactions. That leaves something to be desired, especially with respect to virtual currency and all of its unique features. So this is it. These are the 3 official publications by the IRS addressing virtual currency. It's really not a lot. This next slide is really a high-level summary of Notice 2014-21 and the FAQs. In the left-hand column, you have a list of very common virtual currency transactions. And then in the right-hand column, you have a list of the tax treatment of those transactions. So taking just a few, for example, when you buy virtual currency for cash, you take a cost basis in it. And then when you later sell the virtual currency for cash, you recognize the built-in gain or loss. And say, for example, you take a unit of Bitcoin and you exchange it for Litecoin. That is a taxable transaction, and you have to recognize your built-in gain or loss. No chance that it could be a 1031 like-kind exchange, especially after tax reform in 2017. So this is a list of some open issues, unresolved issues posed by virtual currency transactions. This list is developed by the American Institute of Certified Public Accountants. Lack of guidance for virtual currency tax treatment does put taxpayers in a hard spot because they're asked to take a position on something that's just not clear. So we as tax advisors often would advise a client in this situation just to take a position that's reasonable, that's in your best interest, and when in doubt, you can just disclose it on your tax return, file form 8275, and to avoid any chance of penalties. So while virtual currency tax treatment can be unclear, luckily the IRS has given specific guidance on gifting virtual currency, and you'll find that in the 2019 FAQs. This and the next slide discuss some of the federal income tax consequences of gifting virtual currency, and Richard in part 3 will explore some of the gift and generation skipping transfer tax consequences. So here, as a donor of virtual currency, that's just like donating any other kind of property. And when you donate it to, say, a 501c3 organization that's a public charity, you as the donor are not going to recognize any built-in gain or loss on the virtual currency. You may be eligible for a charitable contribution deduction, and you are similarly subject to substantiation requirements, including, for example, contemporaneous written acknowledgement, filing a form 8283, and getting a qualified appraisal. As the donee, as the recipient of virtual currency, it's not taxable income to you if it's a bona fide gift. And in general, you take a carryover basis and a taxed holding period in the virtual currency. And if you as the recipient are a 501c3 organization, you report that on your form 990, maybe even a Schedule M if that's applicable. And one interesting thing is that if you as the charity receive this virtual currency and then you just sell it for cash or convert it to cash, then that's a taxable disposition, and it needs to be reported on form 8282 if you convert it to cash within 3 years of your donation. So one thing that makes virtual currency so great is that it's inherently anonymous. But the problem from a tax perspective is that makes virtual currency transactions very much subject to underreporting and very much under IRS scrutiny. And so in recent years, the IRS has been increasing its oversight of virtual currency transactions. Earlier this year, the IRS formed the Fraud Enforcement Office, and within that office, you're creating an emerging threat mitigation team, and a major focus of that team is virtual currency. Earlier this year, we also learned that the IRS is hiring outside contractors to process virtual currency data. This signals to us that the IRS wants to pursue these virtual currency transactions, but maybe lacks the technology or the manpower or the resources to really crack down on virtual currency transactions, so needs to seek the advice of third-party contractors. Also in 2019, the IRS sent out over 10,000 letters to taxpayers with virtual currency transactions saying, hey, something seems fishy here about your returns. We suspect you have virtual currency transactions that you haven't been reporting correctly. Please consider amending your returns and paying back taxes. One thing that I find really amusing is the Form 1040, the draft version for tax year 2020. It has a virtual currency question on the very first page. So the form will say, what's your name? What's your address? What's your social security number? And at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? It's like literally the first question. So it really is a signal that the IRS is ramping up its efforts in overseeing virtual currency transactions. And finally, the IRS is putting together some proposed regulations for brokers in virtual currency. Those were scheduled to be published in this summer, but were delayed due to COVID. So it's something we're just keeping our eyes on moving forward. Thank you. Off to Richard.
Hello, I'm Richard Ramirez. I'm also with Baker Botts. I'm an estate planner. I'm a partner as of January 1st of this year. So it's been quite an interesting first year as partner. And y'all have given me a reason to put on a suit for the first time in 6 months. So I don't know how I feel about that, but we'll say I appreciate it for now. So I'm going to go over some of the estate tax issues going on with gifting and giving virtual currency. So first is, what is so exciting about this virtual currency and why are our clients excited about it? First is the fact that it's virtually untraceable, and that's not just for illicit activities. Our clients are always wanting to do things anonymously. They want to give to their family anonymously. They want to give to charities anonymously. That is, unless they're trying to plaster their name on the side of a building, but we won't go into that for now. Next is going to be the low transaction costs. As John mentioned, we've eliminated stock exchanges. We've eliminated bankers. We've eliminated intermediary banks. This is literally a peer-to-peer transaction that a client can engage in by themselves without involving many third parties. Now, that's in theory, because usually an exchange is going to be used. When you're using an exchange, there are going to be some transaction costs in paying that exchange, but those are going to be minuscule compared to what you normally think about transaction costs. And finally, it doesn't matter how much you're sending. You can be sending pennies, you can be sending millions. The transaction costs are going to be virtually the same. Next is the security. As John pointed out, there's a high level of encryption in dealing with cryptocurrency, and so it's extremely secure from being accessed by unauthorized persons. But a distinction that we need to make sure our clients are aware of is the security of the currency itself versus the security of the exchange. If a client is using an exchange, their currency is only going to be as safe as the exchange's security. So they need to be aware of that and make sure they're using exchanges that are reputable and have good security. And then finally, there's going to be no currency conversions. If you're doing a Bitcoin to Bitcoin transaction, there need not be any conversion, and it's going to be available to use worldwide. Next are some of the pitfalls that we're going to see in estate planning with virtual currency. We're going to see some of these topics run throughout my next slides, but the lack of regulations and the lack of a governmental institution behind the currency is going to lead to high volatility in the value of that currency. So leading on to the valuation questions, there's going to be a lot of questions about how do you value it, when do you value it, and how do you make sure that you're fulfilling all of your obligations, either under the adequate disclosure rules or any other rules dealing with giving to charities. Next is going to be a completed gift versus retained interest type of an issue that you're going to run into when a donor may retain a key, or it could be said that the donor retained a key. And then finally is going to be trustee acceptance and liability. This isn't an issue that I'm only going to touch on this slide, but it could be its own presentation all in and of itself, dealing with should fiduciaries take virtual currency and what they should do with it if they accept a trusteeship. In my practice, I know that I'm advising trustees and any fiduciary that if the will or trust agreement doesn't explicitly allow for virtual currency, they should either divest themselves of it or not accept it in the first place. And it is for reasons of the volatility of the value and being able to really lose a lot of money very quickly. So our planned giving techniques, as we've discussed, as Katie and John discussed, this is property just like any other. So all of our planned giving techniques are going to be on the table, whether that's going to be an outright gift of an annual exclusion or more, whether you're going to use irrevocable trusts, such as grantor trusts or non-grantor trusts, grants, family limited partnerships, and charitable giving. Now, we also need to remember that because it's not a currency and it is a property, it has a basis. So because it has basis, before engaging in gift planning with virtual currency, we really need to do a calculation as to what's better for this client in particular, given the basis in their cryptocurrency. Should they give it away, where the donee receives a carryover basis and could be exposed to capital gains tax later? Or should the donor hold it until death, where at death, if it's included in their estate tax return, they'll receive a stepped up basis, and the donee down the road after death would not have to recognize any capital gains up to that new basis. The next, well, back still, Katie, sorry. Due to the volatility of and the extreme fluctuations that can take place in value, it can make hitting a home run really easy in estate planning, but it can also lead to a big waste of exemption. As you can tell, I'm not a big gambler, and for this reason, all of the gifting techniques may be available, but I prefer to recommend GRATs. GRATs can allow you to shift wealth on the short term, take advantage of those short-term swings in value, but not use very much, if any, exemption. And so a couple reminders when dealing with cryptocurrencies and GRATs. First is to segregate your different cryptocurrencies into separate GRATs. You don't want a huge fluctuation up in one to get erased by another coin's devaluation. And so if you separate those out, you can really make sure that you're going to pass along as much wealth as possible down to the next generation. And the other thing to remember is you can always freeze a GRAT. Once that GRAT is in the money and has hit a home run, you can either swap or buy the virtual currency from the GRAT in order to make sure that that GRAT stays in the money and doesn't have a swing downward later. The volatility can also be helpful in a partnership context. You know, we've all had a client come in November that wants to slap together a partnership and give away a partnership interest by the end of the year. It always makes us really concerned about the IRS collapsing the steps, arguing a gift on formation or an indirect gift of the assets of the partnership. However, with this volatility, maybe those two steps could have less time put between them. Remember, in the Holman case, there was only 8 days between formation and gifting of Dell stock, and in the Gross case was 11 days of marketable securities. And those courts said that more time may be needed if non-volatile assets are being used, like preferred stock, bonds, or real estate, and perhaps maybe less time will work with a more volatile asset such as cryptocurrency. Okay, next slide, please. So some of the issues we're going to run into, first is substantiation. How do you prove that you gave away that virtually anonymous cryptocurrency? So one way would be to give your private key as substantiation, which is something we would never recommend to our clients. Another would be a contemporaneous memo, such as is required under the code under 170 in order to receive your charitable deduction. So these two could be combined to make a written acknowledgement that's contemporaneous that shows exactly what the transaction occurred. But please remember that in all of this, cryptocurrency does not meet the definition of a publicly traded security, which means you will need a qualified appraisal. I'll get into that a little bit more on the next slide. But on this last point is what happens if you give your private key to somebody? Anyone would say that's a completed transfer. But what happens if the donor retains the key? Some have considered this issue and said that it results in a completed gift with a retained interest. Then you have to go through the rigmarole of Chapter 14 and figure out how all of that applies to it. Some have considered that it would be a completed gift, but a security discount would be applied to it. That security discount is created by the fact that the donor could always use that private key that was retained to turn around and use that cryptocurrency in a transaction themselves and take it away from the donee. I personally think that the right answer is that it's an incomplete gift. I would analogize this to a bank account. If I put my son on my bank account, I have not completed a gift to him until he actually reaches into that bank account and takes cash out. The same thing applies here. If I give him my private key, we both have access to it. It's not a completed gift to him until he actually uses that key to take some of that virtual currency. So as a planning point then, in order to remove any doubt as to whether there is a retained interest, whether there's security issues, or whether you haven't completed the gift, I would recommend having the donor make a representation that they have not kept any keys so that we can be ensured that we have a completed gift on our hands. The next issue that you'll run into is valuation. So as Katie mentioned, notice 2014-21 is really the only formal guidance on valuation that we have that's been issued by the Treasury or IRS. And really, what that provided was that if the virtual currency is listed on an exchange, then it would be determined by the value on the exchange rate, as long as that rate is determined by market supply and demand, and you must apply rules that are in a reasonable manner that are consistently applied. But now we have IRS FAQs from 2019, and questions 25, 26, and 27 provide for 3 different scenarios and how you value your virtual currency in those 3 scenarios. The first is if the transaction that you enter into is facilitated by an exchange and you're put on a ledger, then the value is the amount recorded by the exchange on the ledger at the exact date and time that the transaction happened. The second situation is if the transaction is facilitated by an exchange but is not recorded on a distribution ledger or is otherwise an off-chain transaction. In those scenarios, the value of the virtual currency given is the value that would have been recorded on a ledger had it been an on-chain transaction. And third is if there's no exchange utilized, like a peer-to-peer transaction. Imagine I just write down my private key and hand it to somebody else. In that situation, what the IRS has said is they will accept as evidence of fair market value the value determined by a cryptocurrency or blockchain explorer that analyzes worldwide indices of cryptocurrency and calculates the value of the cryptocurrency at an exact time and date. So having that document, that contemporaneous memorandum that is dated and has a timestamp on it, will really help to nail down exactly what date and time you should be using for valuation. But again, remember that Bitcoin is not a publicly traded security. So in order to meet the substantiation requirements for charitable giving or the adequate disclosure requirements for gift tax returns, a qualified appraiser should be used, despite the fact that the IRS FAQs are saying that they would accept the opinion of a cryptocurrency blockchain explorer. You know, I had a partner that I used to work for. He's retired now, but he would always say that IRS FAQs are not law and that we need to follow the law. And here we know that we must meet the substantiation requirements, and we want to make sure that we have a qualified appraiser to make sure we start a statute of limitations on any gift tax return that's filed with cryptocurrency as a gift. And finally, dying with cryptocurrency. So some of the issues that you're going to run into, either advising an executor or a decedent or your clients before date of death, is going to be locating and accessing cryptocurrency. Executors should search diligently for the existence of any virtual currency after any death. Exchanges are usually going to be linked to credit cards and bank statements. So reviewing bank statements, account ledgers, reviewing email accounts, or even just searching for an app on a phone or a tablet may result in finding unknown virtual currency. You could also review past tax returns for evidence of virtual currency ownership. You know, as Katie pointed out, just look at page 1 and see if they've ever bought, sold, or exchanged any virtual currency. Next is going to be the method of storing the virtual currency is really going to dictate how the virtual currency should be passed at death. So, for example, if the client uses an exchange, either the executor or the intended recipient is going to have access to that exchange, whether that's a password to it. And remember, there's going to be some of these exchanges have 2-factor authentication systems. So you might not only need access to the account itself, but you'll need access to whatever computer, phone, or tablet is connected to that account so that you can actually pass the 2-factor identification. If a client is using a paper wallet, like it's written on a piece of paper, or a software exchange, or a software that is not on an exchange, then those keys or passphrases need to be either given to the executor or to the intended recipient at death. Or they can be placed in a safety deposit box. Just hopefully the will's not in there too, and the executor will actually have access to it. And finally, we'll have hardware wallets, like a flash drive. You just need to make sure that somebody's aware that it's there, and the executor, for better or worse, needs to be plugging in each flash drive they find, and making sure there's no property on it, such as virtual currency. At death, you're also going to have some valuation issues. They're going to be many of the same issues that we've previously discussed. However, I think that the time and date issue may provide to be a tough issue at death. Many times, your time of death on a death certificate is a guess. It's a time that was determined by someone that wasn't there. And now you have, with the volatility that's involved in virtual currency, minutes, seconds, days, weeks, that kind of time can result in extreme fluctuations in your virtual currency and cause the taxation at death to be very, very different. And finally, everyone just needs to be aware that because it is property, as I alluded to previously, you're going to have a step up or a step down in basis at death, depending on what the decedent's basis was and what the fair market value is at death. And I think that wraps up my part of the presentation.
Good morning. My name is Joshua Goldstein, and I work at Lewis and Clark College in the gift planning office there. And I also serve on the conference committee here for the conference. And so first, I really appreciate this presentation. I appreciate any presentation about appreciated assets. So I want to thank John, Katie, and Richard for doing this for us today. I will be moderating the Q&A session, and we will begin shortly. And we have our speakers here live to answer your questions. Just a reminder to continue to submit your questions through the Q&A feature at the bottom of your screen. And so let's begin. The first question that I think was answered in the chat, but I think is a good one to get things started, is what's the typical value of Bitcoin?
Yeah, I answered that quickly. Right now, a single Bitcoin is selling for about $10,900. And so what typically happens is pieces of Bitcoins are bought and sold rather than entire Bitcoin.
Great. And I think this may have been mentioned later in the presentation, but a question that we got is, why is Form 8282 required if there is no appraisal needed?
I can take that. Sure. Well, one thing, I think an appraisal is needed. There's no exception for appraising Bitcoin. And then Form 8282 would be required anytime you as the charity receive this property and then dispose of it within 3 years of receiving it. And so just a simple taking the Bitcoin and then exchanging it for cash is one of those taxable dispositions for which you need the 8282.
Great, thank you. Can a donor gift a mining computer? And if so, how would that be valued?
That's an interesting question. I can try to answer that one. I think that, first of all, you have the equipment, and that has value in and of itself, no matter what software is on it. So that's going to be one component part of that gift. Also, and then I think from there, the software itself, if John can correct me if I'm wrong, I don't know all the technical aspects of mining, but if that computer can be set up and will continue to mine on its own with virtually no maintenance, then to me that does sound kind of like valuing a business. There are different ways to value. I would want to see the income for the past at least 3 years, if available, that computer has been generating, and we can extrapolate from there. But I think a valuation expert would be needed to tell you exactly how to value that kind of the software and the income that would be generated.
Yeah, and I'll add there is a complicated thing of that's a feature of the technology. So when you're mining, what you're trying to do is to find a certain type of hash, and so it's basically a number with so many zeros in front of it, and you have to try all these unique inputs in order to discover this mining, Bitcoin. I'm struggling with the words, but to find the Bitcoin. And if you find a Bitcoin, that doesn't mean you necessarily need to put it into the blockchain. You could actually hold those back and what would be interesting is, well, what if you had a bunch of solved equations that could be converted into Bitcoin? Well, now you have about an even more complicated valuation problem, because maybe you would want to transfer a computer with a whole bunch of mined Bitcoins and say it's worth the value of a computer or something like that, when in fact it might be worth $100,000 or $1 million or something like that. It's an odd feature of the technology.
Do you have any recommendations for a charity when receiving or acknowledging gifts of Bitcoin? Is it best to left to the donor to determine and let the charity simply describe the gift in their gift acknowledgement?
I think that describing the gift is certainly necessary. I would also recommend having the charity request that the donor represent that they have given, that they have not retained any of the keys. You'd hate for the donor to have retained that and be able to use those coins before you are able to enter into a transaction with them. Other than that, I think it would be up to the donor to see what exactly they'd like to include in that kind of documentation.
Do you recommend that charities market or advertise if they accept gifts of cryptocurrency? And if so, can you share any demographics or other indicators of donors who may have virtual currency to help market to them?
If you are accepting virtual currency or Bitcoin, then certainly I think that is something that people need to know. There's going to be a lot of people that have built-in capital gains with going to want to give away in order to avoid income tax later.
Does a will or trust need to specifically name digital assets, or will those assets be treated similar to other property if they're not specifically named?
So that's going to vary from state to state. I practice in Texas, as I mentioned. Here in Texas, I believe that they would be treated as personal property. And would pass pursuant to any kind of personal property language in a will. But at the same time, it would always be best to have a specific request if you know that your client has any kind of virtual currency.
Is your firm seeing large charitable gifts of virtual currency today?
I haven't at this point, but I believe Jon Feldhammer has.
Yeah, so about 1 to 2 years ago, a lot of the major players in cryptocurrency said, hey, this is now very valuable, and we'll donate this huge amount of money, asset to you, but it has to be a Bitcoin, it has to be a cryptocurrency, it has to be Ethereum, whatever cryptocurrency. And the reason they were doing that was to legitimize cryptocurrency. So they would say, well, we'll give you a $50 million gift, but you have to take it as the cryptocurrency. And of course, the charities that caused a lot of stress, but it did force some charities to figure this out, to get it done. And now, like Fidelity, I think, was one of the first to actually be able to do this. And it accomplished their goal of legitimizing these cryptocurrency donations. And so that was, I think, what a big scramble, a reason why there was a big scramble with charities a year or two ago to accept these. I have seen less of that lately, because now there are more and more charities that are accepting it. It's a great usually low basis asset, or often low basis asset, to donate.
This is a good question here. Is there any way to tell if a key has been shared with others when you receive it as a donation?
So it would depend on how it's donated. So if it's donated as a key, right? So if you are given a key, then you don't know. But if someone's transferring the Bitcoin from their key to your key, well, then you know who has access to that private key. So if someone's giving you a private key, I assume, and Richard can elaborate, especially a charity or a trustee would have a fiduciary obligation to transfer that right away to another key, is that they are the only ones who have the private key. Otherwise, it could end up being stolen.
Are these gifts typically outright, or are they part of split interest gift arrangements?
Richard, do you want to answer that one?
Sure. Yeah. What I've typically seen outright gifts. I haven't seen split interest type arrangements. I think with the low interest rate environment, people are kind of staying away from split interest as much as possible, at least in my practice that I've seen. But I would expect as interest rates normalize that we would see some more split interest transactions.
Great. Those are all the questions that have been asked so far in the chat. If anyone has any additional questions, feel free to ask. Otherwise, I want to thank each of you for your time today, and I really appreciate. Oh, what about charitable lead trusts? I still appreciate you guys, but I have another question.
Yeah, I mean, charitable lead trusts are the type of split interest that we would want to use in this environment. I personally, I just haven't seen any yet. Plus, with the extreme fluctuations that can occur, you know, it could be bad, and it could be a good deal for the donor. And so I think because of that uncertainty, you know, not knowing exactly what is going to pass to the charity, most of our clients have been staying away from split interests.
Great. Well, I want to thank each of you for your time today. This concludes the session, and the recording will be made available to all attendees in the coming week. The last hour of today's program will be a lunch and social hour. So please join us at 12:30, which is in 7 minutes, clicking on the meeting link in the email that you received earlier this week before you get your lunch. And please do log into the meeting before so we can break you into smaller breakout rooms and have informal chats. Thank you for your time, and that concludes the session. Thank you.
Thank you.
Hi, thank you.